Let's talk for a minute about inflation. Okay, inflation, as I record this on October 4th, inflation was just reported for the last month. It's up to 5.25%. Now, to put this into historical perspective, the last time inflation was this high, I was a sophomore in high school, back in early 1991. This is pretty high inflation. Now, the Fed seems to be of the belief that this is going to be temporary and that it's going to come down on its own, and that they don't necessarily need to dramatically raise interest rates, which is what they did back in the 1980s to curb inflation that was over 10% at that time. And so they're still signaling that they're not necessarily in a big hurry to stop printing money and raise interest rates. They think that we've still got lots of deflationary forces in our economy. And so we'll see what happens. Nobody really knows what's going to happen, whether they're right or whether they're wrong. But let's talk for just a minute about what you can do about inflation in your life. And inflation's a very common economic risk. Your portfolio should have already been positioned to do well in the event of unexpected inflation. But let's talk for a minute about those things that do well in inflation. Okay, one of the best inflation hedges is low interest rate fixed debt, right? You got a 2 or 3% mortgage. Guess what? They're paying you to own it right now, right? Because money is becoming less valuable at 5.25% a year, and it's only costing you 2 or 3% to have that mortgage. If you refinance your student loans to that rate, again, they're paying you to use their money. So that's a great inflation hedge for those of you who still have debt. Okay, on the other side, those poor suckers who own that debt in the form of long-term bonds, especially low interest rate long-term bonds, are the ones who are primarily hurt by inflation, right? They're locked in to only earn 2 or 3% over the course of 10 or 30 years. Meanwhile, their money is losing value at 5.25% per year. So that's a really bad place to be in inflation. You don't want to have too much of your portfolio exposed to that risk. It's okay to have some exposed. You don't want it all exposed. Another bad place to be, cash. Now, that doesn't mean in a market downturn that cash isn't better than stocks, right? Better to lose 5.25% a year than to lose 40%. But for the most part, cash does not do well in an inflationary environment. Now, there are a couple of types of fixed income that tend to do pretty well in an inflationary environment, especially unexpected inflation. And these are federal savings bonds, the I-type bonds. I stands for inflation. Those are indexed to inflation. So as inflation goes up, the rate paid on I bonds goes up, and they're actually becoming a pretty good deal these days. The downside, you can't buy a lot of them without jumping through a bunch of hoops. There's some people out there who are forming trusts just so they can buy more I bonds because you're only allowed to buy up to 10,000 a year of them. There's various ways you can buy a little more by, buying some with your tax refund and those sorts of tricks. But for the most part, you're limited in how much you can buy unless you go open multiple trusts to do so. TIPS, Treasury Inflation Protected Securities, are the other type of fixed income that helps with inflation. And you can buy as many of those as you want. You can buy them directly at Treasury Direct. You can go to Vanguard or Schwab or Fidelity and buy them via a mutual fund or ETF if you like. And they tend to do better in an inflationary environment. And just as you would expect this year, they have done better than similar nominal treasuries. The other approach to inflation is to simply earn more than the inflation, right? And so to beat inflation, you end up taking more investment risk. So that argues for things like stocks. These companies can raise the price of their goods and services as inflation goes up and thus increase the value of the company. Same thing with real estate, right? Not only is real estate a lot of times leveraged with low interest rate fixed debt, right? That's a good thing in inflation, but it also tends to be a hard asset that tends to increase with inflation. And of course, as inflation goes up, you can increase the rent charged for your real estate properties. So also a good inflation hedging asset. Then you get off into things like precious metals and cryptocurrencies and commodities. And the idea is that, these are not in dollars. And so theoretically, they should do better in inflationary times. That's quite a bit more variable. They are speculative assets. Be careful how much of your portfolio you put into those. But if we're talking about a single digit percentage of your portfolio to put in any of those assets or all of them together, I think that's fine too, as a bit of an inflation hedge. But that's about it. Other than that, we just deal with inflation. Has its pluses, has its minuses. There are times in life when it helps you, times in life when it hurts you. So hopefully the Fed can get back to their previously stated goal of keeping inflation around 2% a year, which seems to be somewhat ideal for growing the economy.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.